Welcome everyone to this week's Kingscrowd Investment Roundtable. My name is Brian Belley, head of product here at Kingscrowd. I'm joined by Scott Kitun. Scott is media entrepreneur, investor, co-founder at Songfinch and Technori. Scott, how you doing this week?
Muy bueno, Brian. Thanks for having me.
Awesome. Thanks for joining us. Scott is a wealth of knowledge. He's done a lot of venture investing and a lot on the founder side, so he has some awesome perspectives he'll be sharing with us. On the other screen here, I'm joined by Teddy Lyons, Senior Investment Associate at Kingscrowd. How are you, Teddy?
Good to be here, guys.
Awesome. We've got some great topics for this week. We're going to talk about probably two primary things. First, we're going to be talking about some of the data around investment exits to date that have been failures. That means that they've returned less than 1x of the invested capital. We did a data deep dive, and we will be talking about some of that. We will also be talking about one of the investment opportunities that Teddy has been looking at, doing some due diligence on, and looking at for the Kingscrowd Capital Fund. So to kick things off, I'm going to share my screen and we can take a look at failure data. Now, failures is often something that can sometimes be taboo in the industry, right? A lot of founders, for good reason, have put in a lot of hard work, and to see a venture that doesn't unfortunately end up being a success in the end can be a little bit of a disappointment. However, here at Kingscrowd, we really want to make sure that we're putting an emphasis on being transparent and clear to be able to help both investors and founders make better decisions. So one of the charts we looked at was saying, is there a correlation between the revenue that a company is bringing in when they've raised capital online versus the failure rate? And failure here, we're basically defining as any company that has shut down, liquidated, declared bankruptcy, or otherwise failed to return 1x capital to investors. Now, what we see, I think this is nothing very shocking here. Pre-revenue companies have been the highest risk thus far. That is, they have had a 7.1% failure rate, whereas going all the way to the highest revenue companies, some of those later stage, growth stage companies around 10 million plus of ARR have a 2% failure rate. There's a bunch of caveats to this data, right? We're not saying that we know of every single failure necessarily that's been out there. These are just the ones that we know of. Also, there are probably still failures that are yet to be seen that are still going to be coming in the future. But this at least starts to kind of lead us down a path of saying, can we make any trends or gain any insights from this data? Scott, I'm kind of curious, given all your experience running a fund and making your own investments as an angel, what are your first impressions about some of this failure data in the online startup investing industry?
Yeah, I mean, look, I think it's interesting that it seems to be lower than what I would see in normal companies. Like, I think I just saw a report come out that the vintage between 2020 and 2021 is already below 1x or still below 1x in traditional venture, which doesn't mean anything because it's only 2 years ago, and the IPO market hasn't exactly been frothy, nor is M&A. Are we pulling in everything? Is SEC, and if it's filed, or is it are we kind of trying to find those who've self-reported? Because that to me, and you mentioned this, Brian, kind of would account for it being slightly lower. The other alternative that I would say that I think is possible, Teddy, you've talked to a bunch of these founders, so you might know this better than me, but my understanding of a lot of companies that have successfully raised, particularly post-revenue companies that have successfully raised on ECF platforms, is that they don't have the full bore venture mindset. They're not given capital today with this assumption that there's a chip that's sitting out there for tomorrow and the next day and the next day, and they're part of this venture factory. So Kingscrowd is a great example of this. We've raised, $6 million, $5.5 million from crowdfunding and another $2 million from venture. And, this is a 6-year journey, and I think a lot of the companies in the crowdfunding space are probably less inclined to get it and just assume they can go out and crowdfund some more money. And so they're trying to get to revenue. They're probably closer to profitability than most of them. And the last thing I would say ultimately of the crowdfunders is it is, I think, kind of a cool sign in a way, because not me personally, but a friend I know absolutely believes that crowdfunding is where scammers and founders are hanging out and hiding to steal money. And I think those numbers would indicate that that's if so, a tiny, tiny portion of the whole.
No, agreed. And I think kind of another point of why this could be lower than it really is, it's a lot of companies disappear. We don't really know what happened to them. They're not necessarily providing updates on when they go down, or if they, had a asset purchase from someone where investors lost most of their money. So it's still, the industry still has a long way to go in terms of being transparent about exits and failures and all of that, which is what we're trying to do at Kingscrowd, is track them as best as we can. A lot of investors and companies will send us updates when the company informs them, but it's not necessarily public that the company went down. And also, I think, like you mentioned, Brian, this industry is still quite early. Like in traditional venture, it's 70 to 80% or even more of startups fail within the first 5 years. Equity crowdfunding hasn't been around that long. So I think probably see the numbers start to go up and pretty substantially. But I think initial signs are, it's promising.
I'll make 2 additional notes on the data, and I want to go back to one of the things Scott said as well. So that data set, I'll share my screen again here. It is only looking at equity deals. So we're excluding any of the small businesses that raised as a debt or revenue share note. That was a separate data set. This is just equity deals that are supposedly trying to be more of that startup. Now, that being said, I think one of the points you made, Scott, is a good one, where even among these deals who are giving equity, there's probably a split here between those that really have that super hyper growth venture mindset, trying to, hit those milestones that are traditional Series A, B to be able to grow to be a unicorn, versus some of the ones that are maybe trying to be a little bit more organic, that yes, they may have sold equity, but maybe it's more along the lines of a small business. So potentially maybe have lower failure rates because of that.
I mean, Brian, the one thing I want to say though, and I think this is notable for listeners on this episode in particular, because I'm sure there's people out there who are going to be like, equity crowdfunding is not real or it's garbage. And then there's true venture. And the stark reality is, like, the performance in venture over the last 5 years has been abysmal. And that doesn't fall on founders. It falls on investors and funds and honestly, it falls on LPs. It's no different than like our kids creating a problem when we're parents, and like, it's like you try to blame the kid and it's like, well, actually I'm the adult in the room, or I'm supposed to be. The reality of this is like, and it's the nature of the game. In a venture space, you're trying to make money a different way. It's not like small businesses who are like, hey, we took out a loan, we're playing this interest rate game. In the venture space, we're trying to beat everyone to a certain spot on the map as quickly as fast as we can. And we have seen over the last 2 years, with the exception of AI, particularly like the core platform LLM AI, what we've seen is companies are really being told by their investors that they have to try to get as close to profitability as possible. Contribution margin is a focal point, as opposed to just like growth at all costs. That was never a luxury that crowdfunded companies can have. You could have maybe 10% of those companies that like did crowdfunding as a tag on or a peg to a formal venture round. There's only a handful that are notable, and they're mostly later stage. Substack and Beehive as 2 that stand out, Mercury, whatever, that like, it was just a community play, really. It wasn't, a big part of the needed capital. For companies in the venture space that are truly venture, meaning their anticipation of Series A would require that they spend an exorbitant amount of money in 6, 7, 8, 9 months. And you look at the deals, and Teddy, you probably see this as well as Brian. A lot of those deals were getting their second round inside of 9 to 18 months, which is like way faster than it ever was for the last decade. So when you look at this map again, and you look at the chart that you have there, I think you see companies that even at their pace, which they might think is aggressive, it is like nothing compared to how aggressive, the venture companies. Like Songfinch is an example. We were spending 20, 30 million a year to try to grow at a pace to get to, 40, 50 million in revenue. Like, it's just, that would never have happened if we were like, hey, we have 3 million in the bank. That's something you do when you got like 30 million in the bank. And I think that chart shows a little bit more of a responsible pace, even if it was not intended that way. It's just like the way that things kind of got set up. But
yeah, really good point.
I think it's a good note.
The one of the chart I want to bring up really fast, then we'll move on to our pitch review of the week. But this is the failure rate of companies by funding platform, which we actually put together. Also found this pretty interesting. Now, the top 4 platforms here are basically by the number of deals. So they have anywhere from several hundred deals like Net Capital to, I think, 800 nearly for Republic, to over 1,000 and 2,000 deals for Start Engine and WeFunder. So again, failure rates among those top by deal count platforms in that typically 4 to 7% range. So very similar. You can definitely see the other end of this chart, much higher failure rates. Now, part of that is because they have so few offerings. Also, just of note for this data here, any of the ones that have the 2 stars here, so Seed Invest was acquired by Start Engine, we know that within the last year, but some of these other ones, Fundana, Razital, True Crowd, Fundopolis, and Growth Fountain, were either shut down or have been suspended by FINRA SEC or are currently no longer operational. So, some of those obviously standing out with higher failure rates here, but surprisingly on the other end of things, right? Dealmaker Securities, PickMe, and Silicon Prairie, all on the lower end of things. And I think it's a little bit hard to disentangle because some of these platforms have so many different types of offerings, but there are differences in how platforms approach the issuers that they allow in their platform, where some of them do more due diligence on their own. Surprisingly, like Republic here, puts together more diligence, but does have more of that higher failure rate. Again, maybe that's just saying more, though, going back to Scott's point, if they were trying to present more of these venture backable companies, they may be more of the ones that are swinging for the fences. So I just want to make that clear, that just because something is a higher failure rate does not mean it's necessarily worse by kind of the same terms. When you put together a portfolio, if you create a portfolio that's trying to be as low risk as possible, you are absolutely going to miss some of those potential outliers where you can get the outlier returns.
Yeah, Brian, are you seeing similar type of data on the debt platforms, or is that chart for another week?
Yeah, we didn't put together the chart by platforms, but as a whole, the debt deals tend to be a little bit lower risk, as one would expect, than the equity deals. So if we scroll down here, we had a 7.9% overall failure rate for all of the equity crowdfunding safe deals versus a 4.7% failure rate among the debt and revenue share. So definitely seeing that they tend to be, again, a little bit lower risk, probably because, again, they're not trying to be, rushing to those milestones, trying to burn capital to be first mover advantage, that type of thing.
Yeah. No, it makes sense because, the debt deals, more than anything, a lot of them are small businesses. They're not trying to hit venture type milestones.
I think this is interesting and probably like a tee up for another episode. But when we talk about the small businesses, I think it's fascinating that they naturally are like, and I get it why to a degree, but like they're naturally shoved into the debt deal world. And like probably part of it's that the founders are just like, that's what they know. We made this huge assumption like 8 years ago with crowdfunding in general that like everything was tied or somehow tied to venture. And that if you were to raise money, quote unquote, venture from crowdfunding, that it had to be a venture business, when in reality, like even venture funds don't necessarily invest in what I would call like fully venture backable businesses. I'm curious to see how the next like year or two unfold and whether small businesses start raising equity on these platforms, and they're not on there saying like, we're gonna 500x, we're gonna sell to Salesforce or what. Like they're like, hey, we've grown 30% over the last 2 years. We do 5 million EBITDA, and our intentions are to use this $5 million to try to get to $20 million total revenue and $7 million EBITDA next year. Like just stuff like, and then you start thinking about the crowd investors, and like I would be like, holy shit, like frothy on this. Like I would be all about that because those are numbers I understand. And I think that makes the whole business very different. And I don't know what we have to do at Kingscrowd or what these platforms can or should be doing, or maybe I'm completely wrong. But I would love to see more of these SMBs, especially as they become more tech enabled. Apparently now that iPhone 16, you can just run your whole business through Siri. So like kudos to Apple Intelligence. But like once it becomes more pervasive, I would love to see those businesses raise equity more than debt. And I think you'd see a lot of success there for investors. I think you'd see a lot of success for the founders too.
Great discussion. Well, I want to keep things moving. Next on the docket for today. So Pivotal Health. This is a company that Teddy has been looking at. Pulling up the Kingscrowd deal page here, we can see it's rated an overall rating of 4.4. And scrolling down to some of the other ratings, we can see some of the Kingscrowd ratings breakdowns. Teddy, take it away. What are you looking at in terms of Pivotal Health today?
Yeah, so Pivotal Health, quite an interesting one. They're a healthcare platform that allows patients to easily schedule at-home primary and urgent care visits through their app. So for a monthly membership fee, you get unlimited primary urgent care visits from providers that are actually employed by Pivotal Health. So these are providers on the Pivotal Health payroll. So this is anything on the primary care side, from annual physical, cancer screenings, lab work. And then on the urgent care side, anything you get from a typical walk-in clinic. It's interesting because they're operating only in Wisconsin right now. And they're at 883K last year, projecting 1.2 million this year, 5 million next year. And, having just been operating in, this Midwest area, kind of what we're looking at the Kingscrowd side on our diligence of it is how do they really scale at any type of reasonable or sustainable rate? Because, as you're making, setting up shop in each of these different locales, you have to get, an office space, that kind of be the home base for the providers. You need to hire the providers. That's, can be a longer process, especially with skilled labor like this. So sort of one of the things we're going to be asking the founder about is, how much does it cost them to open up shop in a new area? One of the interesting things about their growth plan is they've started to resonate quite well with college students. So, a lot of times, college healthcare centers a lot of them are closed on the weekends, closed at night. And a lot of students, don't just like get the adequate care that they need a lot of the time. So especially in Wisconsin, University of Wisconsin, they sort of like went viral in ways there where a lot of students are using them. It's their first time away from home. Their parents are more than willing to pay for them to, have access to on-demand at-home care whenever they need it. That's part of their growth strategy in terms of where they're looking to expand to next as they move out of Wisconsin. But again, the question still kind of remains the kind of scaling risk of it. It's seems to be quite capital intensive as they start to open up more locations. So that's sort of what we're looking at. There are quite a few competitors out there, pretty small. So kind of in terms of, this being an equity-based investment, how do they really scale to the point where we're getting the returns as investors that we'd be looking for? It's how can they really develop the durable competitive advantage, to quote Warren Buffett, kind of what does that look like from them? That's something we're going to be exploring more with the founder soon. So
getting all the feels going on doing a pitch review. It's been since like 2021 since I did a video pitch review. I forgot how fun this is. So full disclosure, I'm an investor in a company called Gabby, which is a similar telehealth for pediatric, and the whole concept is a wearable, kind of like a Whoop, but like more designed for like typical pediatric symptoms. And they pair directly with, like in my case, how I found them is like Northwestern Medicine here in Chicagoland. And so for like all the overzealous moms and dads who like end up taking their kid to the ER 50 times a year for no reason, they can just sort of tap into it. I think another kind of exposure I had to this market was Glenn Tolman and Livongo, and selling that to Teladoc for a shit ton of money. The telehealth market space, I think, is ginormous. Some people will tell you that it's like overblown in growth because of COVID. I just don't believe that. I think that anyone who has family members that they have to book and schedule medical appointments with will tell you that it takes absolutely forever. And so any device, any service, anything that can, all the forms and stuff you fill out when you get to the doctor, like even the dentist is a pain in the ass, right? So like any device or service that you can have where I can basically knock out the waiting in line. I forget exactly how it went, but the pitch that Gabby guy gave was effectively like, think of this as like the people you hire at Disneyland to wait in line for you so you can go enjoy the park while you're like waiting in line to go up a slide. Do all of the things that the doctor's going to ask for anyway. And I just think that, I'm sure there'll be a zillion people who compete in the space, but there will be plenty of room for all kinds of winners in all kinds of different spaces. Cause as I said, like I was involved in just pediatric. It's very unique to like people who have skin related or heart related or, physical therapy related, whatever, all these things. So I actually am long on the market and the opportunity. I think it will be a clustered space. I forget again on there what the price they were raising at was relative to revenue. That'd be a key indicator. And the founder in general would love to know kind of their team experience in institution, just because this is the biggest hurdle they're going to face is capital and institutional bullshit, probably.
Yeah.
9 billion cap. So like, okay. And does it
about
say here what they got at
900K revenue? Yeah.
And financials, yeah, they grew to about 900K in revenue at the end of last fiscal year.
I don't hate that at all. I think that's a fair price deal.
Yep.
It's worth the
10x
risk.
Revenue multiple.
The founder, if you have any info on whether or not, by the way, Brian, kudos to you. I love the new key challenges, low runway, other risks that you've got bullet on there. I think that is so important that people pay attention to the runway. Like, it's not a reason not to invest in a company, but like if you're the only check, probably not the best if you have a small check. But I digress. Pete Johnson,
the founder here, Sal, who I talked to, he's
okay,
had 4 prior C-suite executive roles at other healthcare companies. Kind of had a pretty long career in the space, so definitely seemed extremely knowledgeable when I talked to him, and kind of understood the challenges. Being in a very regulated space, but yeah. And the thing that's cool about Pivotal Health is it's sort of kind of building on the telehealth side, where they do have telehealth offerings, but it's kind of also offering this, you can have doctors and nurse practitioners like actually come to your house and perform an annual physical, which, I have to schedule mine like 8 months out always at my doctor's office. They're just like so overwhelmed.
The concierge thing in general, I think I mean, you're seeing people do this concierge deal with like chefs, having them come in your house, your kitchen. A company like Savor We in Chicago does this, like, so, and you obviously you're seeing a huge boom. Is it Fido or whatever it is that like has in-home pet care, pet euthanization, all these kind of things. Like when I had my dog get sick and we had to put him down, like we had everything in home, which like changed the experience, I think, in a huge way. So I would definitely say this is a space that I really think is great. I think I like the pace that sometimes these medical spaces go, so long as it doesn't require like insane upfront capital investment in order to even get to trial, which I don't think Pivotal Health falls into that category. So like, I tend to think they're more capital responsible, and like, it's really like a relationship driven game. So you're really betting on the founders to like have built great relationships and ultimately deliver a better user experience for patients than the hospitals, which is like the lowest bar. Like, I don't even know what is the lower bar at this point than the experience of a hospital or ER. So yeah, I think it's I like it. I like that it's priced this way also. Brian, you've been holding back.
It's kind of capitalizing on this trend, this consumer trend that we've seen since Amazon Prime, right? Like people just decide they don't want to go and wait in line in a store. It's about efficiency of time and convenience and getting stuff at your home. And I could see myself as a user of this. One of the things I was telling Teddy before when we were looking at the deal was, I was a little bit worried about just what their business model and the pricing was going to be, because if they say, hey, $75 a month, you get unlimited visits, does it run into this movie pass, type area territory where it's the only people using it are going to be the power users who might make 10 or 15 calls a month, and now you're not, breaking even kind of economically. But I think what Teddy mentioned is that they have been looking more at a distribution model of giving it to employers, and then employers kind of go give it to their employees, and kind of, think of like portfolio diversification. You're spreading the risk of people, any one person kind of overusing it by putting it across an employee population. So as a go-to-market, I think that makes a lot of sense.
Yeah, no,
it's definitely interesting.
Yeah, no, great call, Brian. I think I might have failed to mention that when I first brought the company up. But yeah, it's sort of a very enticing option for employers, especially ones that aren't offering health insurance necessarily to their employees. Like this is a very low-cost option to be like, well, or as an add-on to the insurance that they offer their employees of like, look, we'll subsidize this for you and add this to your benefits package to have at home primary and urgent care. I think it's quite a big selling point. I think they're in 17 employers right now, like 2,300 employees overall signed up through this line of business. So yeah, it's definitely an interesting space that I think will continue to just get bigger and bigger.
I would love to know, on their go-to-market plan with this, using a PEPM model can be a bit of a dicey proposition, especially like an InsureTech and others. If they package this in a way where the employers can tell their employees, many of which are remote or hybrid, that like this is a feature of working here, that like we're actually offsetting so that we don't want you to waste any time. And like, just because you don't need to take doctor's days off and waste a half day, you don't have to do any of that. Like we'll take care of it for you and use this as a sell as like part of our remote employment package. That would be a way I think would be really interesting to sell it, as opposed to like trying the traditional, like, hey, if your employees like it and use it, like they can opt in, like I insurance or whatever, like, which just usually just doesn't work that well. So I think that would be my one question. If I was investing in this business, I would want to know, walk me through that go-to-market, because that could be a competitive advantage for sure.
Awesome. Well, let's wrap things up there. Another great episode. Thank you, Scott, for joining us today. Hopefully you'll be back in some future weeks. Anyone who's watching, you can check out Pivotal Health, check out the article, go to kingscrowd.com. Also, feel free to sign up. We have a free weekly newsletter, Pitch Reviews, where you can get a lot of these in-depth reviews, including some of those chart deep dives. So thank you, everyone. We'll see you next time.